thank you guys all and ladies for being here. We really appreciate it. How do you like the weather we arranged, though? I mean, that took some doing, but actually took a little bit more doing to get Louie and Grant to get here. And as Mark pointed out, this would normally happen in late January, but we thought it was more important to have Louie and Grant and delay a little bit. So thank you again, and we do have a fair amount of ground to cover, so we're going to try to make this a little shorter presentation, certainly from my standpoint, than you're used to in the past. I know that's really good news. So, you know, I think we've all heard the appropriate, in this case, saying, often wrong, but never in doubt, very good. And I have to admit that I've used that a few times in my newsletter and maybe even when I've been conversing, but it's kind of embarrassing to have to say that about yourself. But that's really the way it's kind of been here lately, is the last few years, even though I've felt fairly strong convictions about some of the forecasts, some of those haven't worked out. And I've learned something that I really didn't expect before, which is that if you're wrong about the stock market, you're just plain wrong. It doesn't matter what your other forecasts have been, you're just not going to get a whole lot of credit. And I do want to remind people, though, that maybe got the wrong impression. We weren't bearish on stocks a year ago. We were just neutral. That was our official forecast, was kind of a sideways market. Obviously, that was still a big whiff. And I think it's reasonable for those of you that are clients in the room to wonder why. Why did we miss that? Why weren't we more aggressive? Certainly, we were in the market. It's just that we had some hedges in place that definitely undercut the stock market performance. And one of the reasons is that if you were to look back a year ago on the chart would be your left, and that orange dot that you see, that basically shows where the stock market valuation was a year ago. And this is Warren Buffett's favorite way of looking at the stock market, by the way. This compares total stock market valuation or capitalization to the size of the U.S. economy. Very, very high. Very few points in time in the past where it was worse than this, more expensive. And again, that was a year ago before a 32% increase. But also, I would point out, we don't look at just one of these. We look at multiple long-term valuation measures of the market. And one of our favorites, in fact, my personal favorite, is price to sales. And everybody talks about price to earnings, PE, but we like to look at price to sales because sales are much more predictable. Earnings, as we're going to see in a bit, are extremely volatile. Another reason why we were somewhat apprehensive, if you look at the chart on the right, the blue line shows you the stock market performance. Basically, that's a world market, not just the U.S. market. And the brown line is showing you economic surprises, good news, bad news. And what you can see is since the global financial crisis, there's been a recurring pattern of kind of a peak toward the end of one year into the next year and then a fall off. And in the first few years, the markets kind of track that. But you notice what happened the last couple of years, complete disconnect. The economy, as we all know, has been okay. It hasn't been great, but it's been okay, and yet the stock market has been red hot. Very unusual disconnect, and we'll talk about why that happened here in just a little bit. But I did want to do a quick review of our other 2013 anticipations. I mean, I've got them up here. I really don't want to, we're too time pressed to go through all of them. The biggie that you guys, many of you care about and should care about, that we really did get pretty right was our call about bonds. As many of you know, a year ago, year and a half ago, we really changed our tune because we made, for those of you that have been clients for 5 or 6 or 7 years, very substantial gains on income investments coming out of the meltdown in 08, 09. But about a year and a half ago, we became concerned that the great bond bull market that had started in the early 80s was coming to an end. And boy, did it. It actually reversed a lot quicker than we thought. So very different than the stock market. So major sell-off occurred actually last year, right after Ben Bernanke started talking about the taper. The joke was it was the taper tantrum. And I think that's a pretty good way to characterize it. And unlike a lot of firms, we did actually go into action at that point and bought quite a bit of very depressed income securities at that point. And for you that are clients, I tried to emphasize this repeatedly in our newsletter, we were literally locking in yields of 6 to 8% for years during that panic selling that affected the yield world. And in some cases, toward the end of the year, when tax loss selling kicked in, we actually got 2 investments that were yielding 12%. And they both, fortunately, have appreciated since then, knock on a lot of wood. So, and ironically, since the end of the year, the stock market, even though it's recovered somewhat, it's still, I don't think most people realize this, it's basically flat for this year, for the first 2 months, which is unusual. Usually the market does well out of the gate, and yet the bond market's up about 1.5 points. So I think most people would not realize that bonds are actually outperforming stocks in the first 2 months of this year. That might not continue, but that's the way it is right now. So another why did we fight the Fed? Why did we not say, hey, look, they're printing all this money, let's just ride along? Well, if you look back at 2000, 2003, the Fed was cutting interest rates frantically, and yet the market went down roughly 50%. 2007, 2008, once again, the Fed was cutting interest rates frantically, and yet the market went down almost 60%. So, the old saying, don't fight the Fed, hasn't been true a lot of times. But for sure, with QE3 and with the multiple QEs piled on top of each other, where they've now printed over and I say printed, which is a misnomer, they've created $3 trillion. It's actually electronic money, reserves. They don't actually print, dollar bills like the old, we see the German, the old newsreels of the Germans going to the bakery with wheelbarrows full of Deutsche or Reichsmarks. So, but they have created still $3 trillion. And if you look at the linkage, this chart shows you the linkage between the stock market and the Fed's balance sheet. So there's been if you're statistically inclined, there's been a 90% correlation between the Fed creating money and the stock market going up. So this time around, the Fed has won. Although we would say the important phrase there is at least for now. And we're going to give you some reasons why maybe the for now is not going to be for too much longer. So let's get to this year in our main calls. The biggie, we think this will be a stock shock. So again, we're not neutral. We're, as far as I know, the only firm that we've at least read that is calling for a down year. And we think that a double-digit decline is likely, maybe even a crash at. And I'm not saying this is the end of the world. Frankly, I think for the way we're positioned, this will be very opportune. We'll be able to take advantage of it. And that's why we try to get defensive toward the tail end of bull markets, is so that we can pounce on the next decline. As far as bond and income investments, the good news is very different than a year and a half ago. We think that they actually will behave pretty well, kind of like they've done so far this year. But a key difference is we think the safer, the better in the income world. And that is a change, because as many of you know, and some of you have been involved with master limited partnerships for, Bert, in your case, I think 20 years, and they have been by far the best asset class that we've owned over that period of time. But right now, we're even worried about MLPs. So my point is, in the income part of your portfolios, we are trying to de-risk. We're trying to get even more conservative and go higher quality. Other forecasts, we do think that international markets, as you're going to hear from particularly Louis, will do better than the U.S. We think the economy will continue to be decent. This could likely be the best year we've had of this so-called recovery, which isn't saying a whole lot. Good news, we think inflation is going to stay subdued. I know some of you have heard me say this for years and years and years, and I got a lot of pushback because of all the money being printed, but we said you can't just look at printed money, you've also got to look at the velocity of money, which is, I think Grant will talk about, has collapsed. We think emerging market debt. In case you don't know, that's an area that's been pummeled. We think there's definite opportunities there, much better than U.S. junk bonds. A lot of you may not be aware, last year, the lowest rated U.S. junk bonds were up 15%. Better grade junk bonds only up about 6%. High grade bonds were actually down. So you had a tremendous deviation depending on quality. We think it will reverse this year. MLPs and REITs, we think you've got to be cautious. They're likely to be collateral victims of a sell-off in the market. Commodities, we like gold and silver. I know that cost them some return last year. We still like them as central bank insurance for a small part of the portfolio. And we think that one of the best plays in currencies right now, buy Canada. We liked it a year ago. It's obviously traded down. The Canadian dollar is about 90 cents to the US dollar. We think buying Canadian bonds is a great parking place if you're worried about what might happen in the US. They're not printing money. They should actually run a surplus next year, believe it or not. We don't think there's going to be any kind of budget, fantastic Simpson Bowles type of thing, although now there's a little bit of an inkling that maybe they'll get their act together, but I'm still skeptical. And finally, I think one of the best ways to make money over the next 2 years is to be negative U.S. small cap stocks. They are phenomenally expensive. They're about 50% more overvalued than a very expensive U.S. stock market. So to justify these views, this is I'm only going to show you a few charts because of our time constraints, but these are some of my favorites, and this is right up there. So this was a survey done earlier in the year of the major Wall Street firms, and so the top line is global equities, and what it tells you is that every firm was bullish on stocks, and the bottom line is fixed income bonds. Every firm was bearish on bonds. That was going into this year. And as I already indicated, that's not looking so great so far. What this reminds me of, that I think you might appreciate, this is a chart right before the Super Bowl of what the United States populace thought who was going to win. And Tyler watched the Super Bowl from Las Vegas. I don't know why he went to Las Vegas, maybe to bet a little bit. And I guess they had a map of how the money was flowing. The betting was around the country. And apparently, it wasn't even the Northeast. It was just the Northwest. So that was not one of America's better calls. So whenever you see the consensus that much skewed one way or the other, it gets our contrarian instincts up. And right now, in the stock market, the consensus seems to believe, because again, all these major firms are saying the market's going to go higher. But look at this chart. You know, we say kind of jokingly, are you smarter than a fifth grader? But I really do believe a 10-year-old looking at this chart would say, this looks like trouble to me. This looks like it could maybe go down. And the red line, if you can make that out, that actually is tracking these very high-frequency oscillations that we've been seeing lately. In technical term, it's called log periodic bubbles. Whatever, it has tended to be a signature of a late-stage bull market. We are seeing a number of warnings now that we didn't see a year ago. Did I think that it would get as extended as it has? No. But frankly, it is very, very dangerous. And if it goes higher, and it could, let me say right now, it could go higher. But the higher it goes, the more dangerous it becomes, and we'll have what we had back, unfortunately, a few years ago. So besides printing money, the other thing that's really been behind a lot of this, and frankly, not just recently, but longer term, not just the Fed's money printing, but what's happened with debt. You know, I think if you look at this chart on the left, if you go back to when it really started to go vertical, it was in the early 80s. And frankly, that's when the financial markets really started to go ballistic, was starting in the early 80s. So a lot of what we've seen, and this isn't being negative, this is just being realistic, has been debt-driven. That's fine, but can we continue to increase debt as we have over the last 30 years? I kind of doubt that. The next chart shows margin debt, and I think this should be a real wake-up call, because margin debt has actually gone even higher than what this chart is showing. And the red line, what that indicates is the prior times that the margin debt has gotten very high and what stock market performance has been over the next 2.5 years. And the right-hand scale is inverted, so when the red line goes up, that means the market's going down. When the red line goes down, the market's going up. So what it tells you is when margin debt gets very high, fasten your seatbelts, it's going to be a bumpy ride. And that's exactly what it's saying right now. So again, not trying to be negative, just trying to be realistic. Now the other thing, and this has been a good thing, has been corporate earnings have gone up very, very significantly. But the reality is corporate earnings are extremely cyclical. And the reason that you hear a lot of people say, oh, don't worry about the stock market, it's reasonably priced, it's because they're using peak earnings. And as you can see, it does appear that the earnings cycle is turning down. So that is why you have to look at something that's besides just a pure PE, like the price to sales ratio. But don't take my word for it. I want to show you something that comes from the firm that's got the best reputation for long-term asset class forecasts. It's a Boston-based firm, GMO. And what they're showing, if you look at the chart on the left, is that on large cap US stocks and small cap, negative returns over the next 7 years after inflation. Now you notice that there is a green bar that's positive, and that's for high quality. And that's because high quality companies have really been lagging for a long time. It's been the lower quality companies that have been dominating in most recent years. And actually the chart on the right, what that shows you is that high quality stocks are inexpensive. When the blue line is up, they're cheap. When the blue line is down, they're expensive. So that's good news, is that there are high quality companies that will likely hold up much better than certainly small cap when the worm turns. And that's why in our portfolios, our evergreen portfolios, we are skewed toward those higher quality names. And we also are starting to buy emerging markets, which have been, as many of you know, they've been hammered pretty severely, and I know Louis will talk about that more. One of our other gripes is there's just a lot of optimism out there right now. This on the left is a headline that just appeared on over the weekend in the Wall Street Journal. Individual investors charging into the market. Trading activity at E-Trade and TD are now up 30–40%. You're in the article, they're interviewing people that are discussing giving up their jobs so they can day trade full time. And that's the kind of stuff that we had in the late 90s. It's crazy, it's insanity. What was it, the transaction that just occurred? Facebook is buying WhatsApp for $19 billion. You know what their revenues are? $20 million. I mean, that's a little bit heroic to assume that they're worth $19 billion. So and also on the right, we have the Citigroup panic euphoria, so they measure whether people are really bullish or really bearish, and it's at a very high level. Every time it's hit this in the past, it's been time to start getting defensive on stocks. I mean, the reality is big gains are made when there's a lot of pessimism. And frankly, big losses are made when there's a lot of optimism. There's a lot of optimism right now. So it's just common sense, but it amazes me, having gone through so many cycles over 35 years, how often people forget it. And when the market goes up for an extended period of time, it's just hard to stay disciplined. On the right side, unlike a year and a half ago, a lot of these income areas look pretty decent. I'm not saying we're going to make the kind of money we did coming out of '09, but they look pretty decent. And what's interesting is that even though you might say, well, I don't really care about a 2.7% yield on a 10-year Treasury, it is amazing looking around the world what the other bond markets are yielding. And by the way, the Fed is not buying Spanish bonds, which yield 3.5 right now. Italian bonds yield 3.5% right now, and these are 10-year bonds. French bonds are 2.25, aren't they, Louis? Somewhere around there. So when you look at the 10-year Treasury at 2.7, it's not at all out of line. In fact, I'd argue it's cheap relative to a lot of those other bond markets. We do believe it's time to hunker down a bit with some of the equity-like investments and really focus on what Buffett has said so many times. Rule number one, don't lose money. Rule number two, don't forget rule number one. So we think that's a real, I mean, that's certainly true on the equity side, but we think it's also true on the income side. Another positive for bonds. I mean, one of the amazing things, we talked about this morning in an interview we were doing. I mean, the number one reason the Fed did QE1, QE2, QE3 was to lower interest rates. So here's a chart of interest rates. So when they started QE1, interest rates were about where they are now. They were about 2.7%. They did go down for a while. When they stopped them, they went up to 4%. Then once they phased out QE1, actually when they phased it out, the rates went back down. What's interesting, if you look at QE3, when that started, the rates were about 1.6, 1.7%. So with that last $1 trillion that the Fed has created, interest rates have actually gone up materially. So if their number one goal was to lower interest rates, you've got to say it didn't work. And if their number two goal was to stimulate the economy, you can say, well, maybe that worked, but not great. So we actually point out, unlike most people out there, most investors who are saying, when the Fed quits buying treasuries, watch out, interest rates are going to go up, this would indicate that's not the case. And it's certainly not what we've seen since they've started talking about taper. Now, could the economy, we've only got a few economic slides here, but could the economy take off and really clobber bonds? Because that's what happens. If you get very strong economic activity, interest rates go up. Well, unfortunately, what we're looking at in the country is a decline in the GDP growth potential. It actually has been coming down for years and years. It's not just recently. It goes all the way back to 2000, as we'll see in a moment. And we do have a problem with productivity. We've got a slower growing population. It's just, we're a more mature economy. It's just kind of reality. The other thing that, and I know Louis believes in this very strongly, that's really a problem is with all this free money that's been created, companies, instead of investing in long-term things like plants, new equipment, they've had a tendency to buy back their stock. They've had a tendency to merge. When they merge, they cut jobs. That really hasn't been what the Fed wanted, but it's what's been happening. And that's not great for future growth either. If we look at what's happening in the labor force, it's, we've got 92 million able-bodied Americans that are not part of the workforce. If you look at the number of people on food stamps, welfare recipients, disability seems to be an epidemic around. I mean, this is supposed to be a recovery. This has never, ever happened before. So we definitely have a situation of too many takers and not enough makers. The joke of 5 or 6 years ago was we were a bailout nation. Well, now we've become entitlement nation. And that, if we look at the latest estimates with the ACA, the Affordable Health Care Act, and the minimum wage, that's supposed to cost another 2.8 million jobs. And that's the last thing we need. So we've got some major headwinds that we put in place. And frankly, if it wasn't for the fact that so many people have dropped out of the workforce, the unemployment rate would be over 10% right now. And the chart on the right shows this drop in the growth rate, basically half of what it used to be. And maybe that will change, but given the policies we have right now, we're worried about that. We're worried that we're going to be looking at a lower growth rate for a while. So just as I wrap up here, remember 5 years ago when so many other investors were in the fetal position, we were bullish. I'm not trying to be Davy Downer because I do think there's opportunities. There's opportunities in the income world, there's opportunities overseas, but we have to be realistic about the valuation of the U.S. stock market. I do believe America will get its act together, but unfortunately right now, it's kind of like the Fed has anesthetized everybody with all this printed money, so there's not the urgency that there needs to be. So our plan, frankly, is to hunker down and seriously be prepared to go on offensive during the next panic, and it will happen. I don't know if it's going to be this year, but it will happen, and we want to be buyers when that occurs. So in the meantime, we're just going to focus on some of these yield instruments that I mentioned and play defense as best we can. Thank you very much, and now to Mr. Goff.